Good afternoon, everyone, and welcome to our webinar, Foundations for Homeownership, Mortgage Prep Made Simple. I'm Antoinette Sullivan with Proxima Realty, and we're thrilled you've joined us today to learn more about the financial side of homeownership. We're here to empower you with the knowledge you need to take confident steps toward buying your dream home. I am honored to welcome our esteemed guest, Richard Thierry from Nexa Mortgage. With over 30 years of experience in the mortgage industry, Richard brings invaluable insights and expertise that we're lucky to tap into today. Thank you, Richard, for being here with us.
Absolutely. Thank you for having me.
And today's webinar is all about helping you understand the financial side of homeownership. By the end of this session, you'll have a clearer picture of what to expect financially and how to prepare for your journey to homeownership. So before we begin, Richard, can you share a bit about your journey in the mortgage industry and what inspires you to help people become homeowners?
Absolutely. Well, the word inspire kind of sets the table, certainly for the introduction. Um, Corporate world, 9 to 5, large corporation, and it was where I was. And they decided, after millions of dollars of preparing this call center I was working in, they decided, you know what? We're not a call center company. We have people to do that. And so they outsourced it, and they outsourced it to an area so far away, it didn't make economical sense to ship us all to that new area. So there I was, unemployed. And a friend of mine suggested that I go talk to someone at Bank of America. And there I was in Bank of America. And would you believe they hired me on the spot? And that was my introduction to banking. It started with business banking. And then I had an epiphany. After dealing with so many business customers, I realized every business customer had consumer accounts, but not all consumer customers had business accounts. What I'm getting at is I was on the wrong side of the fence. So I got into consumer banking, thereby had a bigger pool of potential business. And from the consumer business, began referring people to the home loan guy. And I started doing so well with the pre-screening of the home loans, he said I should just do the job. And when he suggested I do it, I said I didn't want to deal with it. It's a 100% commission job. But then he told me I could pick my own hours. And I signed up that same day. So there you go. Which is a perfect segue, Sister Antoinette, if you don't mind, as to going into home ownership. And it is this gravitating to kind of the old grabbing the bull by the horns concept is why you and I are such adamant encouragers of home ownership.
Yeah.
You know what I mean? Opposed to going by the landlord or your mother or your cousin's rules. Why not purchase your own home and then you make the rules instead of being concerned with having to abide by them? So that's kind of what got me to where we are.
I agree. I agree. Having stability, having control over that important thing, your shelter, where you live, where you go to every day after work, that's such a big deal. But you can't get a home until you can afford to purchase one. And most of us use a loan. Not all of us are fortunate enough to have cash like that, um, but that's the way the world is. Everyone gets a loan of some sort. And so that's why this conversation is so important because I want our viewers to understand the costs associated with applying for a mortgage loan. So, Richard, can you explain what are some of the typical out-of-pocket expenses buyers should prepare for beyond the down payment, and how can they better anticipate and plan for these costs?
Absolutely. Well, typically, and it's probably the biggest misconception out there, Antoinette, is the down payment. Certainly, there was a time, and there actually, I can give you an example. There was a time when you had zero down programs, and
Mhm.
I can show you a way, and I will in a minute, of putting together a situation where it is a zero down program. But I'm even speaking more aggressively about times when there was one loan and it was 100% of the purchase price. For example, if the house was $600,000, the bank would loan you $600,000. That didn't work out very well. History tells us that when an individual, what we call, don't have what we call skin in the game, we
Yeah.
find that those default numbers, statistics seem to go up drastically, right? And so
Mhm.
the banks have kind of figured it out. You know, their concept is, you know what? I think it's a great idea. Now, what do you have on it? What would you like to commit to? We will
Mhm.
commit most of it, but we will not approve or go forward with your approval until you have a commitment of some kind. So the most common misconception of that is that you need 20% down. Well, that's definitely not true. As a matter of fact, there are still programs such as Home Possible, Home Ready, and things like that. Well, potentially you can go with zero down, but typically there is an expectation of the down payment, and that is the beginning of the cost. The other costs, believe it or not, are somewhat all negotiable. As far as who pays them, it's completely negotiable. If you don't mind, I'd like to share my screen just for a moment.
Oh, absolutely. Go ahead, Richard.
I had some numbers down. I want to show two screens actually. That I'm going to first start with a smaller version. Give me permission, please, to share. Start with a shorter version of an estimate for a loan. This is a look at a $600,000 purchase using down payment assistance and the closing cost and everything. This is a Cal HFA down payment assistance loan. This is a 30-year fixed loan with no prepayment penalty, nothing quirky about it. As you can see here, it says other financing, and it's referring to the down payment assistance. So in actuality, this is a no money down loan in that you have 96.5% from my company, Nexa Mortgage, and then 3.5% being loaned to you by the Cal HFA program, California Housing Financing Agency in Sacramento. So this is a scenario where you actually have no money down. However, I'm going to jump down here. I know everybody wants to talk about the payment and everything, but I'll get to that. However, this does cost you $25,000. This is your out-of-pocket cost, okay? And so this program offers a fixed rate. It changes daily. I could even give you the link. Today, the rate is 6.125. And again, it's a 30-year fixed rate. This is what you're going to typically see, Sister Antoinette, from a lender. This is the shortest version that they can give you. What I'd like you to see now, something is a little more complicated, which is this. Did my screen change to my loan estimate?
It did, and I was wondering, is this what the borrower sees at the beginning
Yeah,
stage of their pre-approval? Okay.
they would. And it's not very involved. And there's two reasons for that. One of them is that this document right here is a 3-page document. It just gets more complicated. So a lot of lenders are afraid to bring it up because it's so busy, right?
I
However,
see.
this is a teaching class. So we're going to use it as a teaching tool, right? And so here
Yes.
you are. The interest rate is spelled out for you. The loan with the bank is the principal and interest portion of the loan, of the payment, okay? This is something I put out there at the very beginning. I tell them you have a 30-year fixed rate and your payment will never change for 30 years, okay? However, I will be contacted and say, my payment has changed. Well, why has your payment changed? Your payment has changed because your taxes went up, because your insurance company went up. Insurance is a whole different game for us, since Sister Antoinette, than it was 3 years ago before all of the California fires. Now, whereas we used to shop at multiple places for insurance, sometimes we're just shopping looking for one insurer because so many have turned tail and left the state of California due to the abundance of fires. So anyway,
Hmm.
those two factors, the property taxes and home insurance, are not factors that are connected to the terms and conditions of your home loan. So that's why when you see this busier document, it shows $3,579.63 as your principal and interest payment. That is what the bank is guaranteeing. They're guaranteeing you that will come to play. As I go further down this document, you see the mortgage insurance is here, $264. That's what people refer to when they say PMI. Okay, what is that? That's private mortgage insurance. It's an awful terrible thing, because the best scenario I can give you for this insurance is an example of you paying my car insurance. And I love this funny little story because I always finish it by saying, the only way you paying my car insurance benefits you is if I run into you. And the chances are not likely. First of all, I'm a very good driver, so I won't hit you. But what this insurance is, it's insurance that you're paying the premium for on your loan. PMI says to the FHA folks, don't worry if Antoinette bails and doesn't pay her loan. We have insurance on the loan. So therefore, you'll find that the FHA rates are lower. Their terms and conditions are more lenient and all of that. Why, you guys? Because they're insured. It's not that I'm going to say that they don't care if you don't pay the mortgage, but they're more comfortable if you don't pay the mortgage. They do have a backup plan. Did you have a question?
Richard, yeah, I do. I want to jump in there and ask about this PMI and the and just kind of expand off of what you just said about having insurance on this loan. Is it because the the money man is afraid that you might bail because you didn't have a whole lot of skin in the game to begin with, and that makes you kind of a higher risk? And I also wanted to share with you something that I tell people all the time about that PMI. They have to pay it over time because they didn't put at least 20% or a greater down payment up front. Because my understanding of PMI is that goes away after you've put 20% back into towards the loan. Is my understanding correct?
It is. It is. There are variations to that. As we look at, I don't want to get too deep on you, but it's a teaching class, right? When we
Right.
look at three options of loans, and I'll keep it to that. There's a fourth that comes to mind, but it doesn't come into play too much here in the middle of the concrete jungle here. The VA loan. Give these veterans, and thank you for your service, by the way. The VA loans, way more lenient. Here's the money, have a good time. The conventional loan, a little tougher now. The FHA loan is the most lenient loan. So the variation to your question about PMI, the answer to it is that is a true statement for a conventional loan, but not for an FHA loan. I don't care if you put down 50% on an FHA loan, you will have PMI. And that's just the way it is. What is their customer pool, Sister Antoinette? These are not just people who don't put down very much money, but these are also people who have had what we call a disqualifying event in their lives. What is that, Richard? That's bankruptcy. That's foreclosure. The time frames, and I'm going to share this at our next meeting. I wasn't prepared to share it today. The time frames for you to recover from those things is much shorter when it's FHA than if it was conventional. Therefore, FHA says, hey, we have the right to get this extra insurance on this guy. For Christ's sake, he just filed bankruptcy 4 years ago, 2 years ago. And if he went to a conventional lender, the conventional lender would tell him adios for at least 4 years, whereas FHA says, hey, if 2 years have gone by since you've had the bankruptcy, we're ready to do business today. And so it's the yin and the yang of lending. It's the interest rate versus the credit score. The 780 FICO person comes in, walks on water. He gets a very great interest rate. The guy walks in behind him with the 620 and he whines and moans and he says, I want the same rate this guy did. And I say to him, and I wanted you to pay that car off instead of letting it get 60 days late, And so it's a yin and the yang of what got you to this situation.
I
Did you have
see.
any more questions about PMI before I go on to taxes?
No, not at all.
Okay, thank you. All right, so then we talked about the $3,579.63, and Richard said that this is your guarantee. This is what we said. This is our binding agreement that we did at the title company when we signed. We said, we promise you this is your monthly payment. It was referencing your principal and interest. We're here talking about costs. So now let's talk about costs. Not just the monthly $264 a month, but there's also something called upfront mortgage insurance premium. And I'll get to that in just a minute. The taxes and insurance are there. As you can see, they both have boxes checked next to them because they are going to be included, okay? We're going to put that as part of the monthly payment. So we would add this $775 and the $264 to the 357,963 number. And by the way, you must be approved for that entire number. We cannot just approve you for the principal and interest portion. We have to approve you for the entire amount. So we go down. We're talking about cost in this meeting. This is the reason that I think, I don't know, maybe I'm being too hard on my competitors. This is the reason a lot of people will not show you all of this information. That's a large number. Your closing costs are $35,217. But a lot of this is going to be the prepays and the taxes. What is that, Richard? That is down here in other costs. Here you have it where it is pointing out to you that you need 3 months of home insurance premiums. And also we want 6 months of property taxes collected. These are all things that people will call costs all day long. But listen, you guys, this isn't so much cost to do the loan. It's the cost of ownership. That your house is insured. You didn't give this money to us and we said, oh, thank you, have a great day. We took this money and we prepaid your home insurance. This is just like a car. Anybody here that's bought a car before, you can't drive the car off the lot, Sister Antoinette, without a showing that you have proof of insurance. So those are a couple of the items that are interesting. Now, the elephant in the room, the origination charges are there. These are the charges that the bank and Cal HFA are charging you to get the loan. At the end of the day, you are paying $25,085 to buy a $600,000 house. And that is basically, really, I don't want to say it's all you need to worry about, but it is the only obligation you have. When and where that money is due, first of all, when someone is selling you a house and they agree to on the terms and conditions and the purchase price, they will ask for a deposit. So if you were to give them a $5,000 deposit, you would need the $20,000 balance at the end of the 30 days when the deal is to be closed. All right, I talked a long time. What kind of questions do you have?
That was a long time, and that was good information. I was taking notes. Thank you, Richard. Thank you for that
No
presentation.
problem.
But I have a question about how does down payment assistance help reduce the initial cost of buying a home? Does down payment assistance or any assistance help with those closing costs?
Absolutely. They are earmarked to be used either way. They can be used to any side of the fence you like. Obviously, the bank wants to see as much skin in the game they can. By saying you're going to use them for closing costs, you do not lessen the bank's obligation. In other words, if, for example, the 3.5% on this example I have on the screen is $21,000, the bank is going to approve that loan sooner by you putting $20,000 on the house and lowering their obligation by $21,000, more so than if you said, I want to put this toward my closing costs. So it's always better used. Your goal is always to lower it, and if you don't mind, I'd like to speak about the down payment a little further.
I do, and I was just thinking, me myself, when negotiating with a seller, I would try and get as much of my client's closing cost um, lowered or just non-existent. I try to negotiate that closing cost. So I can see why a buyer would want to use the down payment assistance for that down payment rather than the closing cost because it could vary.
Absolutely. And I'm glad you brought that up before I left this screen. Thank you so much. Being that the buyer has, in this scenario, has received this $21,000 down payment assistance, Sister Antoinette, that means that the bank is satisfied with the minimum. We have satisfied the bank's requirement for the minimum amount down. Therefore, all of the other costs by rule of FHA can be paid by the seller. And so you mentioned asking for help from the seller. All of the $25,000, if it is possible for the seller to pay it, if they are in a position to pay it, that is acceptable. And as a matter of fact, in a FHA loan, which is what we're looking at here, the seller can credit up to 6% of the sale price. So this is a $600,000 purchase. 6 times 6, they could credit this buyer up to $36,000, and the lender would not bat an eye. That would not be a problem.
Okay.
So I wanted to speak on a couple of down payment assistances. I just want to keep everyone in mind that Antoinette and I were speaking on this earlier. And if it says it's a down payment assistance, then it's a loan. And so sometimes I get into debates about with people about things like having to pay it back and the terms of the down payment assistance because they vary, right? And sarcastic comment is always my sarcastic response is always, if you can buy the house without the down payment assistance, please do. And so it's typically the buyer who is initiating the down payment assistance cost. And so I have up here now, this is the Boost program, and I get so many different suggestions as to what I should look into. And Richard, can you tell me about any down payment assistance that's available in Oakland, or can you tell me about anything that's available in Antioch or Brentwood, and what are they all about? Honestly, I researched them as needed. But kind of you seen one, you seen them all. And what I'm getting at is the fine print of so many. This is the Boost program, right? And it says applicant eligibility requirements. Look at this, you guys. Now, this program will give you loan you $210,000. It also has some terminology that you should be aware of that says shared appreciation. What does that mean? Shared appreciation. That means as the value of your house goes up, and your wealth grows, you share that wealth with whoever loaned you the money. So they kind of keep their hands in your pocket as well. But look at the tight guidelines here. Buyer must live in Alameda County, work at least 32 hours per week in Alameda County, or then you think that, or you're like, oh, well, there's an opening, or have previously lived in Alameda County and have been displaced. So you see where I'm going with this? So you got to be careful, That's a lot of money. First of all, it's a loan, Antoinette, and I don't like that because now, my house has gained, $300,000 of equity, but these people are standing behind me and says, do you have our $210,000, by the way?
Right,
So, yeah.
right.
And so when and where is it useful? Honestly, I'm more on the boat of family members, people asking for help to buy their Tesla or their Mercedes is not as well received as asking for help to buy a home. I know my father helped me when I bought my first house, and he never regretted it. I'm in my second house now, because why? Because I created some wealth by being a homeowner, right?
Right.
This is the down payment assistance for the Antioch Housing Affordability Program. It's too busy to read, but they're saying that the person must have at least $7,500. That goes back to where they live. They want them to stay in the city. They have requirements as far as when and where they can leave the property. They have the income breakdown here. If it was just one person, that person can't make more than let's say $85,000 a year. Antoinette, that's about $7,000 a month. Okay. Let's just go backwards. I showed you a principal and interest payment of almost $3,600. $7,000 a month. If I used a 50% DTI, debt to income ratio, then the maximum that person could make would be something with a $3,500 a month mortgage payment. They couldn't even buy the house that I showed you an example of earlier. So again, you see what I mean? You got to watch out for those kind of requirements.
So buyers should do their due diligence when deciding to use a down payment assistance program.
Make sure you do the research. And most of them have also, most of them have specific lenders that they will use. You must be an approved lender to use a lot of those programs. Okay. And then comes the other angle with that. Who is this other person? Who are these people that you're going to work with, Antoinette? In our business, just because they're a real estate person doesn't mean that you're going to jive with them. Just because he's a loan person, just because he's done loans for 30 years, is this guy honest? Is he truthful? Do you trust him? And so that's another thing that as soon as you do hear about the program and you find you're eligible, will you have the back and forth that you wanted to have from the person that's taking care of your $500,000 purchase, right?
Yeah. So thank you for pointing out some of the potential drawbacks or challenges that buyers should be mindful of. And Nexa Mortgage is known for standing out in the industry. So can you share with us what sets Nexa apart from other lenders, and how does it make the process simpler for potential borrowers?
That's a perfect. I should be their spokesperson. After, several years, very many years of being on what we call the retail side, working for the big banks, I recently came to Nexa in February of this year. Um, Nexa gives ownership to me. Nexa um, is basically at my beck and need, saying, "What is it that you like?" I have gone from offering only the products that the big banks that I work for are offering to now having a slew of products that I can do. I met a gentleman this morning, and he was under the assumption that I could only do consumer loans. That's not true. That was true before February, but now that I'm with Nexa, I can do business loans, I can do construction loans, I can obviously do the FHA loans, commercial loans, VA loans. And so the thing that stands them out is that they are looking for a way to complete the transactions, you guys. They are really on board. I have a full 24, well, 9 to 5 access to coaches. People who have been in the industry for much longer than I have, and I've been in it a long time, who are willing to spend time with us. I know that you are super satisfied with your management where you are. I can certainly share that feeling with you here, in that, I feel as though the sky's the limit with where I am, because the resources are unlimited. And so it really stands apart when it comes to the products available. All those things that I mentioned to you today, I am available to offer. I am approved lenders for all of these programs. So there is no gaping holes that comes into play here at Nexa.
Okay, so we've got a little, I'm going to ask if any of the participants have any questions, and if they do, feel free to speak out or drop your question in the chat. Okay. Well, Richard, what is one practical tip you would give buyers to prepare for the financial side of purchasing a home?
I don't mind. The first step is to talk with a lender. I know that all of the business that you referred to me, there is obviously some great conversations that you're having initially, but you always strongly suggest that they have a detailed conversation with me. And you're such a professional, you don't really need the intricate details. You talk to Richard, and Richard will talk to me, and I just really appreciate that about you, and the trust that you have in me. I will go as far as, for the scaredy cats, I will approve and deny you and tell you what you need verbally. If you're that afraid, there are all kind of scams going on. It's amazing to me that my cell phone, sometimes it just says on there telemarketer, and I'm like, why would I answer that? Well, I mean, what's my incentive here? And so I understand people are worried about sharing their information. People sometimes tell me their situation, and they tell me I'm asking for a friend. Whatever. Okay, you're the friend, I know. But tell me where you are. Let me hear a starting point from you, and let's go from there. Tell me, if you're in the middle of a breakup. Tell me if you're in the on the process of bankruptcy. Tell me if you have such great credit that you don't want to run your credit. Okay, well, great. Then if that's where you are, then I will assume and set you up in this program, which is a perfect program for your A1 credit. And hey, we'll take it from there. I mean, but we have to have a starting point, is just the conversation. I don't even want to put the pressure on them and saying run the credit. We can do that if we all agree that that's what the next step should be. But let's start with the conversation.
Conversation is what we're here for, and we'll be having
Absolutely.
more conversations coming up. Richard, I don't have anything else, and I don't see anything in the chat. And so I'd like to begin wrapping up. And Richard, thank you so much for sharing your insights and expertise with us today. Your advice
Absolutely.
and guidance have been invaluable, and I know our audience has learned a lot. And to everyone who joined us today, thank you for taking the time to invest in your future. Remember, the more you know, the more empowered you are to make informed decisions about homeownership. So I encourage you to continue following us for more great conversations, whether it's asking more questions, sharing your thoughts, or connecting with us directly. Your journey to homeownership is unique, and we're here to help every step of the way. And remember, knowledge is power, and so is staying engaged. Thank you all, and have a wonderful day.
Thank you for having me, Antoinette. Look forward to
You're
doing it again.
welcome, Richard.
All
Thank
right.
you. Thank you for
Goodbye.
being here.